Hello, everyone, and welcome to the June 2025 market update. Let's go ahead and dive right in. We've got a couple of new slides I want to jump into today. So let's take a look at the numbers. Again, as always, we're looking at the 5-county area, which includes Wake County, Durham, Johnston, Orange, and Chatham counties. And new listings in June of this year were actually up over 19% compared to June of 2024. So this June, we had just over 3,600 new listings come on the market, compared to just over 3,000 last June. So again, while inventory is going up, new listings are going up. As you'll see in a minute, we're still below kind of what we would consider historical norms and where we need to be for a healthy market in terms of new listings and active inventory. So I'd say this is not a bad thing, but certainly something we're going to continue to monitor to see where that ceiling falls. Year to date, we're up about 14.4% in terms of new listings coming on the market over the first half of the year. Closed sales up 5.4%. So that's a great little change of trend. Last month, we were slightly down in terms of closed sales compared to May of 2024. So this month in June, compared to last year at this time, we were up over 5%, which is great. But year to date, we are still down over 1%. You see that gross number there, 13,170 closings the first half of the year. So we'll see how that shapes up as the year continues. But just know that this was June was a positive note here in terms of closed sales going up. Year to date, we're still slightly down. Median sales price for the month, year over year, was slightly down 1%. So again, that's compared to June of 2024. Year to date, the prices are flat. So if we look at all the sales year to date, first half of the year, median prices at $450. This is a trend that is likely leaning towards, by the end of the year, year to date prices will be down. So we started the year with prices continuing to go up year over year. We saw in June prices go down. So we'll be watching this closely. If you've heard me talk at all recently, I believe prices in reality are falling. We don't see really strong data on paper to support that. But when you have as many agents as we have at Choice, we get to have a lot of these conversations. And I think there's no question that prices are in fact falling. Now, inventory is up 52.8%. This is really similar to what we saw last month, kind of been common all year long to see this amount of inventory increase has stayed pretty steady. So year over year, again, up over 50%. We have 7,713 active homes on the market at the point that they took that data. And just to give you a point of reference here, June of 2024, there was 5,049. So you can see up over 50% increase from last year. Still not an unhealthy number. So don't get blown away by the percentage. The gross numbers are still really important here. And when we look at months of supply at 2.9 months compared to last year, it says May. That's just a typo. Compared to June of 2024, where we had 2 months of inventory. But again, 2.9 months, let's just call it 3 months of inventory, certainly is not unhealthy. That's a really balanced market. But what can get lost in that static figure is what the trend lines are doing. So, of course, we're seeing inventory gradually start to increase. But just in a vacuum, being at 3 months of inventory, not a bad place to be as long as we continue to see the sales transactions occurring. All right, so let's take a look back in history, June 2019. As always, the last year prior to COVID, kind of throwing the real estate market on its head. Inventory in June of 2019 was just over 8,300. Again, slightly higher than what we're seeing in June of this year. Supply of inventory was at 2.3 months. So a little bit lower. Median sale price, $296. Weren't those the days? And so when we apply what we consider kind of normal price appreciation in our market, 5.5%, if we had taken that straight line, 5.5% appreciation over the last 6 years, that would have put us at just over 408,000. Again, as always, we look at these numbers here and we see median price for June of this year was at 465. So we still have a lot of runway where prices can remain flat or even come down some over the next year or two. And that will help us get prices more in line with where they would have been had we not seen the 20+% spike that we saw during COVID. So that's just, I think, a really important number to keep in mind as the markets start to get accustomed with where homes are priced. And of course, affordability, as we get into in our last slide, plays such a big role in this because the median price is going to be less impactful if wages and interest rates and inflation across the economy are at levels that make the median home price not seem outrageous. But when those other numbers aren't aligned with home pricing, things get out of whack like we're seeing right now. So new listings that came on in June of 2019, 3,800. And again, we were at 3,600, so not that far off this year compared to 2019. But where you really start to see the divergence is in closed sales activity. Over 3,500 closed sales in June of 2019, only 2,600 in June of this year. And again, that year-to-date number, this year, June 2025, year-to-date, halfway through, we're at just over 13,000. Back in 2019, we were at just over 17,000. So that's 4,000, almost 4,000 sales transactions that did not occur this year that did occur in 2019. I think we can all agree that we have more housing units today. We have more people living here today, but we're just not seeing that those transactions happen. Even though we are now, 2, 3, 4 years really removed from COVID, where we brought some of those sales forward during those years, we should be getting beyond that point where our softer closed transaction data is related to the sales that were pulled forward during COVID. So hopefully we are getting to the tail end of this and we'll start to see some normalization. But no question, as always, it'll be tied strongly to mortgage rates. So let's jump into a couple of things here. I'm not going to stay on these slides with the numbers too long, but just to show you kind of the gross inventory levels. We typically will see inventory continuing to climb all year long until we get to somewhere in the May, June, July timeframe, sometimes even earlier, that the inventory levels will peak and then start to come down. What we saw last year was that they continued to climb a little bit throughout the year, stayed steady in the third and fourth quarter. So we'll see what happens this year. If we look at this as a chart, you can see that normally we would think of a peak in our inventory levels happening sometimes as early as April, sometimes as late as July, but somewhere in this range, we're usually going to see kind of the peak of inventory levels, and then we'd see them start to fall off. But last year we saw them hold strong all the way through October, and then we saw the seasonal drop off in November and December. This year we have a really healthy trend line, or kind of what we would expect to see. This is kind of a normal trend line. And so we'll see if inventory does start to level off as we come to the end of summer or not. But time will tell. But at least the first half of the year, we see pretty normal, healthy trend lines there. So a new slide I want to show you. I'm not going to hang here. I know there's a lot of numbers and your eyes probably just glossed over. This data is really here more or less just so I can create the next chart you're going to see. But I wanted to go ahead and plot the closed sales data from 2024 to 2025, but then also 2019, just so we can kind of see how these things compare against each other. So this is a line graph of these sales. Now, as you can see, the top line, this is the yellow line here. This is 2019. So of course, the number of sales, this is year over year for each month. The number of sales, of course, were higher in 2019. We know that. We've beaten that to death. The orange line here shows 2024. And then this, reddish pink line shows 2025. But the thing you'll notice is that the shape of these line graphs are going to be the same. So the trend that we're following both last year and this year are pretty similar to what we saw in 2019, which is kind of a normal line graph here. What you find is that sales transactions in all three of these years charted were peaked in May. So very common. Then you'll start to see sales transactions start to fall off as we go through the summer, and then they'll bottom out in September. And then you see this strange little uptick in October. Number of reasons for that. As summer comes to an end, people are preparing to go back to school. They're taking vacations. There's just less sales activity happening in August. But then as we get schools have started, people are done with their vacations, they start house hunting again. We see this tick up in October. Then we'll see it fall off again going into November. And then thanks to people moving, thanks to new construction, trying to get things closed at the end of the year, not uncommon to see this uptick come December. And then transactions will fall off a cliff in January. So if we look at 2024, for example, you can see December of 2024, we ended up over 2,000 transactions, probably somewhere in the 2,100 range. And then you come to January of 2025, and we're down to 1,500, right? So 600 transaction fall off from December to January. Very common to see that happen. And then very common to see quickly closed transactions start to climb up until May. And then like clockwork, we see them fall off again. So I just like to point this chart out. I think it just shows you that even though gross number of transactions is down, we're seeing kind of normal, healthy, typical trends in our market, which I think is great. There's a lot of room here, a lot of gap to be filled. So once our market does open up, again, probably due to interest rates, whenever they do start to lower, we got a lot of room to make up here. And I think it'll be a really strong market. I want to just show you one other chart with this sales data, the closed sales data. And this is cumulative year-to-date numbers. And I threw in an extra data point here, which is 2021, just as a point of reference. If we consider 2019, which is our yellow line here, to be kind of what we would have thought was normal. And actually, this closed data was a little constricted by inventory even in 2019. But then you've got 2021, which was kind of the only full year of COVID craziness that we had before things started to slow down in the summer of 2022 and the second half of 2020. Things were just starting to heat up. But 2021 was our full year of COVID craziness. And of course, that was hampered by inventory as well. So had there been more inventory, those numbers would have been even higher. Same thing in 2019. Can't really say that for 2024 and 2025, which are these lower lines. You almost can't even delineate 2024 from 2025. That's how closely we are tracking this year to what we did last year. But more inventory would not necessarily, in fact, we know it wouldn't, it would not increase these numbers. Whereas for 2019 and 2021, had there been more inventory available, almost certainly we would have actually seen higher closed transaction data. Not the case now. Inventory is not what is slowing down our transaction count. It is other factors, mainly interest rates and the impact that has on people who currently own homes. So I just thought this was an interesting chart. Again, it shows you the runway, the amount of gap we have here to fill. And I think whenever we do break out of this lack of churn in our market, we're going to see it. We're going to see a lot of transactions. I don't think we're going to, get back up to that 2021 level anytime soon. But I do think we're going to see a really strong market once we get even kind of a moderate break in interest rates. So there's a lot of room on the horizon here, a lot of good news on the horizon. For you agents out there listening to this, just remember you've got to stick it through in these markets. You've got to keep doing the right activities so that when we come out of this, you're here to reap the reward. So keep putting in the work. I promise you it will pay off. All right, just a couple more slides. We're going to wrap it up for the day. Thanks for bearing with me. The ratio I like to always look at here, the new listing to closing ratio. This kind of tells you how painful is it for sellers. It doesn't really tell you what it feels like for buyers out there, but it will tell you kind of what it feels like for sellers. This is essentially how many listings need to be taken in order to have a closing. So this is a year-to-date number, 1.57. This has been trending down, of course, as we go throughout the year. This is the way it always works. I would anticipate we're going to end the year somewhere between 1.4, probably closer to 1.5, which would just mean that you would need to take 6 listings in order to sell 4 houses. So that means there's 2 unhappy sellers there. If we look back to 2009, you had to take 8 listings in order to sell 4. 2008, you had to take 8.5 listings to sell 4. So we're still not in a terrible place. But when you look at historically here, where we've been for the last decade, it's been 2011 since we've seen a number like this. So, and of course, if you were around in 2011 selling houses, you remember it still felt painful for sellers. It wasn't until 2012 that we really started to feel the reprieve, the market feeling a little better, listings really moving. So we'll keep an eye on this one. But again, this kind of, if you're feeling the pain as a listing agent right now, this gives you an indication as to why. And it's not just because this number is so bad. It's just because it's so much higher than what we've had for the last decade plus. And when it's different, it's hard to know how to react. You're trying to control how sellers feel and what their expectations are and what your own expectations are. So just know you're not alone. We'll continue monitoring this number. as the year goes on. And then last thing I'll end with is the same thing that I've been saying now for going on 3 years, which is that affordability is kind of the thing that we need to watch. As this number improves, then we'll start to see an opening up of the market. But we're at 70, which essentially means that the median income is about 30% short of what it needs to be in order to afford the median priced house in our area. If we look back to June of 2019, the affordability index was at 140, meaning that the median income that families made in our area, they had 40% extra income, in more income than they needed, rather, to afford the median priced home in our market. Now they're only making 70% of what they need to afford the median priced home. And we've been under 100 as this index since March of 2022. So we're up over 3 years now where we've the median income in our area has been below what's needed to afford the median price home. That means housing is unaffordable. And you see these numbers all across the country. It's not just our market, but this is why you see article after article about first-time buyers being squeezed out. Been saying it so really since March of 2022, but this number is going to dictate when we come out of this tighter market. And hopefully we'll start to see some reprieve as we get towards the end of the year. I would say don't hold your breath. Continue providing value and service to the people in your network. That's all we can do right now is deliver the service that we as real estate agents bring. So continue doing that. We'll continue watching the numbers. And that's all I got for you here in June 2025. Hope this market update is helpful for you. Go out there, make it a great day, a great month, and a great year.